the section we're going to be working on now is corrective patterns. We've looked at all the impulse waves, and every impulse wave is followed by a corrective pattern. Page 249, an example of all the corrective patterns that Elliott took the time to catalog. There are no others, and once you have these under control, you won't be unpleasantly surprised by anything that the market throws at you. There are no exceptions to these patterns. If nothing else, you may not always know where you are in a corrective pattern, but at least you'll know that the pattern is corrective, not impulsive. And that can save you a lot of money, it can save you a lot of energy, and you can avoid a lot of aggravation with that realization. Most of the patterns that we'll look at are corrections within a bull market pattern. Everything applies in regards to a bear market pattern. All you do is hold the chart up to a mirror. This sheet, and again, the handout that you have has 95% of the material that we'll be covering. If it's not covered there, it's in Chapter 2 of Elliott Wave Principle. In conjunction with this chart, and I'll just put this up for a moment, is on the back of one of the handout pages, and that pretty much tells you everything you need to know about corrective patterns. Now, the first pattern that we're going to take a look at is the zigzag. We're on page 217. Zigzags are labeled ABC. We use letters for corrections instead of numbers, as we do use for impulse waves. And it has a specific structure to it. Within the pattern, the B wave does not move into price territory beyond where the A wave began. In a zigzag, this B wave will not exceed the origin of the wave A. Now, a zigzag subdivides into a 5-3-5 pattern. Although depending on what degree chart you're looking at, all the subdivisions may not be visible. For example, if you're looking at an hourly chart, this is what you might see, this upper pattern. If you look at a 15-minute chart, this would be the subdivisions of the zigzag. So it could subdivide 1-1-5. What's important is that the A wave and the C wave are 5-wave structures. The B wave will be a 3-wave structure. And zigzags most commonly occur in the wave 2 position. So let's take a look at some real-time examples. We'll flip to page 219. This is a chart of heating oil, December 1982. And what this is a correction in a bear market. The underlying trend is down. Well, what do we know about a zigzag? You've got 5 waves in the A, 1, 2, 3, 4, 5. The B wave subdivides into a 3-wave pattern, and then the C wave subdivides into a 5-wave pattern. The B wave does not move beyond the beginning of the A wave, and the C wave exceeds the end of the A wave. I should mention, once this pattern was complete, what you would expect to see is a continuation of the previous trend. That's all a correction does, is interrupt that trend. Heating oil was down to 30 cents in 1986 following this rally. Let's take a look at page 220. This is an hourly chart of the Dow Jones Industrial Average, September through October, 1984. This is a zigzag correction. Notice 5 waves down within the A wave, a 3-wave V, and I'll just mention the diagonal triangle occurring in the C wave of that pattern, and then another 5 waves down for the C wave with an expanding diagonal triangle, in this case in wave 5 of C. The B wave does not exceed the point at which the A wave began, and the C wave moves past the end of the A wave by a substantial amount. Let's take a look at page 221. What we see here are two simple zigzags, and there's a simple three-wave pattern between those two patterns. Well, what is that? That's labeled as an X wave. An intervening rally or decline between two simple three-wave structures or two simple three-wave patterns is labeled as an X. X waves can be any three-wave structure. Any X waves are always corrective, and any corrective pattern can qualify to be an X wave, although most of them are zigzags. Most X waves that you'll see. Now we're going to start talking about the convenience of alternate labeling, and this is the best chart to use to begin with this. Now a zigzag is a simple three-wave structure. Is there another way that this can be labeled? In other words, if this is a simple ABC, could we label it AB 1, 2, 3, 4, 5? And the answer, of course, is no, because I'm not sure if wave 3 is the shortest here, but certainly within this five-wave structure that you would want to call wave C, wave 4 comes back and overlaps the territory of wave 1. Using the same argument, you could also not go 1, 2, 3, 4, 5 and label that as wave A, B, C. In other words, in a zigzag, the A and the C are either 1s or 5s. Can you put the five-wave structure here? The answer is no for the same reason. 1, 2, 3, here's wave 4, coming back, overlapping the price territory of wave 1. That's not allowable. The pattern carries the same message as a simple zigzag, but it's best labeled as a double zigzag, and therefore you don't break any rules. Page 222 is an example of a double zigzag in real time. This is the stock market, actually the S&P Composite, from January 77 to March 78, and this is best labeled as a double zigzag. ABCX, ABC. Why can we not label this AB 1, 2, 3, 4, 5? Because you'd be counting this as a wave 1, and wave 4 would come back into that price territory, and that's not allowable. Why could we not go 1, 2, 3, 4, 5 for A, B, C? Same reason. Because this overlaps, comes back and overlaps the price territory of wave 1. Now let me just show you, we looked at extensions in impulse waves. Well, there are extensions in corrective patterns as well. We start with a simple zigzag, ABC. Now remember when we talked about extensions in impulse waves, all we were really doing was adding 4 waves to the structure. We were changing a wave where you only saw one of the subdivisions into a wave which had 5 subdivisions. We were adding 4. So if I were to add 4 waves to this structure, I would have a total count of 1, 2, 3, 4, 5, 6, 7 waves. And we'll see that that carries the same message as does a 3-wave decline. Because I can label this, we said that in a zigzag, either the A or the C wave may only show one wave, and one of them could be a 5-wave structure. So this could just as easily be labeled A, B, 1, 2, 3, 4, 5. In this case, since we don't have any overlap, and the 3rd wave is not the shortest. Suppose I add 4 waves again. Now what I've got is just back to the original definition of a simple zigzag, 5, 3, 5. As we looked at on page 217, this top chart. Now let me show you something else here. First of all, if we add 4 waves to 7, we get 11 waves. This also can be carried on infinitely, and this is a different set of numbers than what we saw for impulse waves. Impulse waves, 5, 9, 13, 17, 21, and so on. Corrective waves are always 3s, or if you add 4 to it, is related in an additive fashion to a 3. 3, 7, 11, and so on. They all carry the exact same message. A single zigzag, what would be labeled as a double zigzag, or in this case, and watch what I can do, I can label that from a single zigzag, I can label it as a double zigzag, ABCX, ABC. But I can just as easily come in here, labeling it in that fashion, and now I've got a triple zigzag. Single, double, and triple zigzags all carry the same message. They are a sharp interruption of the trend that is in force. Among the three of them, they comprise what we refer to as the sharp family of corrections. And that'll come into play later when we talk about the rule of alternation. Let's take a look at a couple examples of double and triple zigzags. Page 223, the stock market in April of 1986. And what's labeled here is minuet wave 4, 4 with an underline. We're on page 223. A, an irregular wave for B wave. C, notice that within this ABC zigzag there are 5 waves in the C wave. A 3-wave X, and then another zigzag. 5 waves down for A, B, C. I have a question. Why could we not have labeled the second zigzag in this fashion, A, B, 1, 2, 3, 4, 5, as the C wave? Because the third wave is the shortest. That's exactly right. Now let me point out that I can correct that by labeling it as a triple zigzag in that fashion. They all carry the same message. You can count this pattern as a simple zigzag. There's no alternation if you do it. It would be counted A, B, 1, 2, 3, 4, 5 for the C wave. Can you see that? 1, 2, 3, 4, 5, finishing the C. Any of these 3 wave labelings is valid, because in every instance it belongs to the sharp family of corrections, so your question as far as alternation is concerned is answered, and it carries the same message. Let's take a look at page 2.4. 2.24. This last rally right into the peak at Dow 1340, and this is the market action in August and September of 1985, is a simple zigzag, 5 waves up in the A wave, 1 wave for the B, 1 wave for the C. That's acceptable. The decline is best counted as a triple zigzag. A, B, 5 waves down for C for the first zigzag, X. A, B, C for the second zigzag, X. A, B, C, finishing the triple zigzag. And that's basically it. The nice thing about that is that we've just covered all the sharp corrections that there are. Zigzag, single, double, and triple. They're a persistent decline or rally against the main trend. The next group of corrections that we're going to discuss are all the sideways corrections. So let's move on to page 225. Okay, now flat corrections have a different labeling internally than do zigzag corrections. They are still labeled ABC, but the subdivisions are different. And so is the look. Remember, a zigzag is a sharp correction. A flat is part of the sideways group of corrections. In a zigzag, the B wave does not get anywhere near where the A wave began. In a flat correction, The B wave returns almost exactly to the point at which the A wave began, and the C wave comes down and finishes almost exactly where the A wave ended. The A wave in a flat correction subdivides into a three-wave structure, the B wave subdivides into a three-wave structure, and the C wave subdivides into a five. Again, the hourly subdivisions may not always be visible depending on what length chart you're using. Any one of these can just be a 1 on your chart. But on a smaller scale, you would probably see those subdivisions. Flat corrections most commonly occur in a wave 4 position. Let's take a look at a couple real-time examples. Page 227 is a chart of heating oil from 1980 through 1983. The A wave subdivides into a three-wave structure. In this case, the A wave is a zigzag. The B wave subdivides into a three-wave structure and comes back almost exactly to the point at which the A wave began. Once the B wave is complete, the C wave traces out a five-wave structure and finishes up very close to the territory where the A wave ended. Following this decline, heating oil went back up over 105, which is what you would have expected to see a new high to the pattern that ended here once this corrective pattern had ended. Let's take a look at page 228. This is a chart of silver, September 86. What we see here, the pattern that we're looking at, is this A, B, C, three waves up, completing the A wave, followed by a three-wave decline for the B wave, coming back roughly to the area at which the A wave began, and then followed by a five-wave structure for a C wave. And remember, Bob spoke about how fifths in commodities were usually the longest and strongest wave, and that was true here, even in this little corrective pattern, coming back and peaking, in this case, near the end of the A wave. Subdivisions are correct, and the look is correct. This is a sideways correction. Once this correction was complete, you would expect the trend that had been in progress to resume, and silver ultimately came down to about $5.10. Let me just point this out. Standard charting techniques, what we're always taught and what we're taught initially, are very helpful at times. But there are also times when the perspective that we get from Elliott is something that you will not see anywhere else. At this point, with this move in silver, you're breaking out above a 2-month peak on what looks like strength and decent volume. And standard charting techniques scream breakout to you. Right? But the perspective that's given you by Elliott says, well, that may be the case, but you should at least be aware that the pattern that you're looking at here could be a flat correction, and we could be finishing the C wave. And at that point, you would look at all the other indicators and all the other tools in your arsenal to see what decision you wanted to make. But only Elliott gives us that perspective. Let's take a look at page 229. Now, a slight variation on a flat correction is what's the pattern that's known as an irregular flat. These are essentially the same, and I think many times when you hear me speak, I'll refer to an irregular as a flat because they carry the same message. They're both sideways corrections. Basically identical to the flat, to the flat correction. It has the exact same subdivisions. Just imagine if you grab the B wave of a flat correction here and grab the C wave here and stretch them a little bit. That gives you an irregular correction. I don't know if that's how Elliott defined it back then, but that's the picture. It's labeled ABC. You may not see all of the subdivisions depending on what length chart you've got, but when you do, there will be three waves in the A wave, three waves in the B exceeding the point at which the A wave began by a substantial amount, and five waves in the C wave also exceeding the point at which the A wave ended by a substantial amount. And like flats, they most commonly occur in the wave 4 position. So let's take a look at a couple examples. Page 231 chart of July corn back in 1986, and the pattern that we're interested in is the pattern that interrupted this downtrend, interrupted the main trend. Remember, that's what corrections do, right here. You've got 3 waves up for an A wave. You've got 3 waves down for a B wave, moving substantially beyond the point at which the A wave began. Following that, you've got 5 waves up, completing a C wave, substantially above the point at which the A wave ended. Once the correction is over, the trend that was in force resumes. Again, with standard charting techniques, without the perspective that Elliott gives you, saying, well, this might be a flat, this might be a corrective pattern, I need to be aware of all these other possibilities. Standard charting techniques say you hate them right here when they break down below this point, and then you've got to love them here when they break out above that, and you were right for a little bit there, but then you don't have the opportunity to short them into strength. Rather, you've got to short them into a breakdown when they come back maybe and below this, but not necessarily until they take out this low right here. We'll talk about that. That's a point of recognition, because that's fairly apparent that that's a third of a third. Let's take a look at page 232. This is the stock market back in 1973, and the pattern that we're looking at was an interruption in the bear market from 1973 through 1974, which was quite a devastating bear market. Let's take a look. The A wave subdivides into a 3-wave structure. The B wave subdivides into a 3-wave structure, which can be labeled as a double zigzag. A, B, C, X, A, B, C. And then the C wave subdivides into a nice 5-wave structure. The B wave comes substantially below, in this case, the beginning of the A wave, and the C wave moves substantially above the end of the A wave. The market declined from this level down to its low in 1974, below 600. Let's take a look at page 232A. This is an interesting chart. This is the stock market just last year, April, May of 1987. And the irregular that we're looking at is the pattern is in a B wave position from this A up to here. You've got a 3-wave structure for the A wave. You've got a 3-wave structure for B, which is a zigzag, a very clean 5-3-5. And then you've got a very nice 5-wave structure for the C wave. Let me also point this out. This entire structure was a zigzag. A, B, C, ending here. The orthodox end to a pattern is not necessarily the lowest or highest point within that pattern. It is the orthodox terminating point, though. C, in this case, does not move below 2195. C bottoms here at 2206. The orthodox low of this pattern is at 2206. It is not considered a failure, in spite of the fact that it did not take out this low. In order for this to have been considered a failure, C would have not taken out the low at the A wave, 2245. Okay, that's it for flat corrections. Now, what I would like to do is, if you would skip ahead a few pages to page 238, and I would like to discuss triangles at this point. For one reason, triangles are the last group of sideways corrections. All the patterns on page 238 come under the heading of triangles or horizontal triangles. There are a number of characteristics that we're going to go through. These are all on the handout sheet that you've got. Every wave in a triangle subdivides into a 3-wave structure. And let's take a look at contracting, since it's pretty much a prototype. 3 waves in each leg of the triangle. The triangle is labeled in that fashion. Now these are specific formations. They are not just anything between 2 lines. They are like diagonal triangles in that respect, in that they're between 2 lines, but they are never bounded by lines which are both up or down. In other words, let's take a look at contracting. This line is declining, this line is ascending. If one of the boundary lines is up or down, the other line is either always horizontal or in the opposite direction. In an ascending triangle, the top line is flat, the lower line is ascending. In a descending triangle, the top line is descending and the lower line is flat. In an expanding triangle, the lines diverge. You never see them both going in the same direction. As we will see, trend lines for triangles are phenomenally accurate. As Bob mentioned earlier, all we do is make the trend lines a little bit more apparent by connecting some points. It's really the markets that draw the trend lines themselves. Now let me show you how the trend lines are drawn on a triangle. The correct way that Elliott said to draw trend lines are by connecting the ends of points B and D for the upper trend line, in this case, in this example, and the lower trend line is obtained by connecting points A and C. Where the E wave ends relative to the trend line is not a factor in drawing the trend line. Essentially, wave E can end anywhere that it wants to, except beyond the end of wave C. E can end anywhere it wants to relative to this trend line. It cannot take out the end of wave C. If it does, there's one thing you know with complete certainty. That's not an E wave in a triangle. You may still be in a triangle, but that's not the E wave. Or some other count may be taking place. Now, as a general rule, triangles occur alone only in positions prior to the final movement in the direction of the larger trend. Let me draw that. Now, triangles occur alone only in positions prior to the final movement of the major trend. So if this is a 5-wave structure, here's your triangle A, B, C, D, E. It would occur in a wave 4 position. In this case, it's occurring in a wave B position. Now, triangles can also occur in wave X positions, but they will never occur alone in a wave 2 position. Triangles never occur alone in a wave 2 position. We will see a couple of cases later where a triangle appears as part of a combination correction in a wave 2 position, but never alone. Now, each 3-wave pattern within the triangle can be any simple pattern, any simple corrective pattern, although it's usually a zigzag. It's not necessary, as we'll see in some later examples. Once the triangle is complete, the final impulse wave that moves out of the triangle is generally very swift, and it travels approximately the distance of the widest portion of the triangle. Now, we're going to take a look at the thrust of the triangle and the correct way to measure it in just a moment. But first, let's take a look at page 239. Occasionally, the B wave of the triangle will go to a new extreme beyond the point at which the A wave began. If this is a 5-wave structure, this is 3, 4, 5, the B wave can enter new price territory above the peak of wave 3. Additionally, this could have been an ABC down just as easily. The B wave, in this case, enters new price territory beyond the peak or beyond the bottom of the 3rd wave to the downside. And let's make that an ABC, just as a reminder of where triangles occur. The net result of the triangle is always corrective. Even if wave B goes to a new peak here, you would expect to see wave E come down and be a net corrective result relative to the end of wave 3. This is page 213. We looked at that earlier. I think if you just jot it down, it's not necessary to flip back. We'll take a look at the left-hand portion of this page right now. This was from the August 86 letter of the Elliott wave theorist. The textbook illustration is this top chart of a horizontal triangle. Actually, this is ascending. The top line is flat. The lower line is rising. And here's what the market actually did. Now notice, each of the touch points is exact or very close. And what that told you was, pay attention, you're coming up to the final move in this structure. Sometimes when you're counting along a structure, you don't know, because of the guidelines that you've got, you're just not sure exactly where you are. A pattern can be counted, sometimes a pattern can be counted as a flat or an irregular. You're not quite sure if there's alternation. A triangle almost always says the next move up is a sale. The next move up is completing a pattern here. Or the next move down would be a purchase, depending on which way you were looking at the chart. This information telling you the next move up is probably the last move in this series, in this case, added to the diagonal triangle here, was a very powerful message. Elliott provides all this information. All we need to do is sort it out. Okay, now we're going to take a look at thrust measurements, and then we'll take a look at some real-time triangles, some other real-time triangles. We're on page 239A. Elliott defined thrust as a swift, sharp impulse wave following a triangle. The only exception to that would be when waves 1 and 3 are not extended. Now, if you think about that, it makes a lot of sense. If waves 1 and 3 are not extended, what did we learn earlier this morning? What would you expect? In a 5-wave series, usually one of the waves is extended. If 1 and 3 are not, wave 5 probably is. In that case, the thrust is not as good an estimating tool as it is in many other cases, and we'll see that some of them are almost exact. In a contracting triangle, the thrust measurement is obtained by extending the two trend lines that you've drawn, line BD and line AC, back to the point time-wise where the triangle began. This triangle began at this point, time-wise, on your horizontal axis on your chart. Now, in order to obtain the measurement for thrust, measure the distance between the two trend lines. In this case, it's a good example, it's not important where the A wave began as far as the thrust measurement is concerned price-wise. What you're looking at is the distance between the two trend lines time-wise relative to where the triangle began. Extend this trend line out to where the triangle started, which is here. Extend this one back to where the triangle started, which is here. The way I phrase it, you drop a perpendicular, as long as you don't drop it on your toes, perpendicular to the horizontal axis where you're measuring time. That distance between the two trend lines is your thrust measurement in a contracting triangle. In an expanding triangle, it's obtained in the same manner, with the following exception: it's obtained time-wise relative to where the triangle ended. You'd extend line BD, you'd extend line AC. In this case, E comes down. I don't recall if I mentioned it or not. If I did, let me repeat it. In an expanding triangle, the only requirement for wave E is that it moves beyond the end of the C wave of the triangle. Just the opposite of what you'd look for in a contracting. It does not matter where this E wave ends relative to this trend line. The thrust measurement is obtained by extending those two lines to the point time-wise where the triangle ended and measuring that distance by dropping a perpendicular. We are not interested in the distance to the price where the triangle ended for measuring the thrust. We are interested in the distance between those two trend lines. Now we're going to take a look at several examples of these, so if you don't get it immediately, it only took me a couple of years, and I usually draw it right now. Let's first take a look at page 240. This is a chart of the Swiss franc. Who can tell me what's wrong with the way the thrust measurement is drawn on this picture? Okay. We can go back to the start. Exactly. Thank you. Thrust must be measured time-wise relative to where the triangle began. And this triangle began, in this case, since it's a contracting triangle, at this point. So what do we need to do in order to obtain that thrust measurement? We need to extend the trend lines that were drawn through points AC and BD so that they extend back to the beginning of the triangle. The measurement that we then want is obtained by drawing a perpendicular line, it's the shortest distance between these 2 points, time-wise relative to where the triangle began, connecting these two trend lines. That's great. Now we've got a thrust measurement. Well, what do we do with it? The thrust measurement, once it's obtained, is either added or subtracted to the end of the triangle in order to project where the next impulse leg will end. This point is roughly 58. This point is 44. That difference, 58 minus 44, is 14. The triangle, that's the thrust measurement, 14 cents in this case. The triangle ended here at approximately 48 cents. What we do with that is subtract the 14 cents, giving us a target of 34 cents. Now this thrust measurement here was taken from this, which is incorrect, and is actually down here at 34 cents, which would have been a little bit closer, although the other one, even though it was drawn incorrectly, wasn't bad. What you've got here is a bear market that lasted 6 years, 1979 to 1985, and this thrust measurement coming out of the triangle pinpointed the bottom. And additionally, the triangle told you, get ready, the final move in this sequence is coming up. Let's take a look at page 240A. This is a chart of silver. This is a descending triangle, which means the lower line is flat and the upper line is declining. How would we draw the thrust? The A wave began at this point. So we need to extend this upper line We can extend the lower one for good measure. No pun intended, of course. And then what we do is draw the shortest distance between those two lines relative to where the triangle began. And that's approximately $1.50. What do we do with that? We subtract it from the end of the E wave in order to obtain a target. Now this E wave peak is roughly 660 or 665. So we take 665 and subtract $1.50 from it, and that gives you a target roughly of 515. I think it's actually 513 is the target. Now, silver ultimately bottomed at 510 in a fifth wave failure in August of 1986. And that's how accurate this tool can be at times. Let me point something else out, which is very interesting about triangles, and we've noticed it often enough that it's something that you should look for. The E wave of a triangle is typically very emotional and is typically associated with news. In this case, it was news that was allegedly good news, that the Hunt brothers had sold all their silver. Therefore, there was no more overhanging supply above the market. In addition to this, in addition to the excitement of the news, you've also broken above this trend line. Now, this is a 9-month trend line. We broke above it. That's got to be bullish, standard charting techniques. Not only do we break above it, we closed above it. And there's good news. What's not to like? Well, Elliott tells you, because you've acceptably completed a triangle here. Let me also point this out. If silver were to move from this point at 665, or 660 was the close, above this point, which is roughly 685, or thereabouts, the C wave. What happens if this move continues and takes out that C wave? What do you know about your labeling of this peak as an E wave? It's incorrect. And that would be a great place to put your stop, because the pattern that you thought was the highest probability turned out to be incorrect, yet you've kept your risk small. Let's take a look at page 240B. Now, this is a long-term chart of bonds, updated through fall of last year. But what I really want to take a look at here is this triangle occurring in what we've got labeled as an X-wave position. Triangle began here. This structure is an ABCX. Remember, we said X-waves were usually zigzags, but any corrective pattern, any three-wave structure would qualify. And here's a triangle, ABC, up to the peak just over 105. Let's take a look at this thrust measurement. How are these trend lines drawn? Points B and D are connected. Points A and C are connected on the triangle. They're extended back to the point at which the triangle began, time-wise. This line is drawn to obtain the measurement, the thrust measurement. Now, this point is roughly 90, the upper point, and this lower point down here is roughly 53, giving you 37 as your thrust measurement. What do you do with it? You add it, in this case, to the end of the X wave, to the E of the triangle, which occurred roughly at 67. So 67 plus 37 yielded a target of 104 in the bonds. Now maybe there's a case where we wished we'd have paid a little bit more attention to that guideline, but still, it was extremely accurate. This peak, I believe, in nearby was 105 1/4. Let's take a look at page 241. This is a chart which appeared in the August '86 letter of the Elliott wave theorist. Bob was looking for an immediate low in the transportation average, and he got one. And there are a couple reasons that I want to take a look at this chart. One is for the thrust measurement. Again, here's a case, it's an estimating tool. You extend the lines and then take the measurement time-wise relative to where the triangle began. and then in this case subtract it from the end of the E wave. And that's roughly 5.5 centimeters or so. I'd say your target's somewhere right around there. One observation that we've made in regard to triangles is something that they seem to have a tendency to do. In the E wave of the triangle, look at the structure here. This is an A, B, C, D, E. What you've got is a triangle E completing a larger triangle pattern. Let me just show you another example of this. This is in your book at page 136, and you can just mark it down. Here's another example. This is silver, and Bob's going to discuss this chart later. But look at the wave 4 in this silver contract. A, B, C, D, and then look at the E wave, which is a perfect ascending triangle. A, B, C, D, E, completing E of the triangle and the wave 4. Okay, now let's take a look at page 242. This is a chart of the Dow Jones Industrial Average on an hourly basis back in April and May of 1986. It's an example of an expanding triangle. Expanding triangles are rare. They're not all over the place. Contracting triangles occur much more frequently. Nonetheless, this was a good example of an expanding triangle, and it had some other interesting properties. A, B, C, D, E. Trend lines are drawn through points AC and points BD. Thrust measurement is not as useful in an expanding triangle. But take a look at this pattern. Within the E wave of the triangle, you've got a B wave triangle, or a triangle that comprises wave B. And the reason I want to show this, for one reason, just take a look at this. I think it's unlikely that you would have had that exact labeling in real time. You may have, but I think there are certainly other ways that you can count that. But there's one thing that you know about that. That's not a high confidence area, and it's certainly not impulsive. And that knowledge, as Bob mentioned at the very outset, it's the things that can hurt you that you really need to avoid. That is not an impulse pattern right there. Now this is interesting. What you've got here is an expanding triangle that lasted 2 weeks, and you've got a contracting triangle that lasted 4 days. Bob showed this chart earlier, constant dollar Dow. And what we see here is an expanding triangle from this point to this point that lasted approximately 30 years, followed by this wave 4, which is a contracting triangle that lasted 20 years. Even over all this time, the psychology and the patterns all still apply. There's a 30-year, a triangle as large as 30 years. Let's take a look at this one. This is a chart of bonds, Dees bonds a couple days ago. And look what they did. This is a 15-minute bar chart, by the way. This is a triangle in a wave 4 position, A, B, C, D, and then look what bonds did to finish off the E wave. Another nice little contracting triangle, A, B, C, D, E, before they thrust it up. I think thrust up would probably be better. The triangle that we just looked at here, which is actually, these trend lines should be drawn on the larger triangle. On a 15-minute chart is this triangle in that position on the hourly. So these patterns work even on the smallest scale. That is pretty much it for corrective patterns as far as different ones that you will see. We're now on page 233. This is not a new pattern. We talked about failures in impulse waves. Well, there are failures which occur, although somewhat less frequently, in corrective patterns. Now, A.J. Frost called these running corrections under certain circumstances. Elliott called them irregular type 2s under other circumstances. The focus, though, is that wave C does not make a new extreme beyond the end of the A wave. And any of the patterns that we looked at, zigzag, flat, or regular, can have a failure in a C wave position versus an A wave. These are labeled ABC. They are rare, and they occur most commonly in the wave 2 position, which makes a lot of sense because usually the longest and the strongest wave is the third wave. And the third wave can't wait to get underway, and that's why it makes sense that a failure in a corrective pattern would occur just prior to the onset of a third wave. Let's take a look. Page 235. Mostly for placement, most likely area to expect a failure, right, in a corrective pattern is in a wave 2 position just prior to the onset of a powerful third wave. On a reasonable size degree, I don't think that we've labeled any failures in the letter that were any more significant than the one on page 236. This is the stock market, Dow Jones Industrial Average, from June through August of 1985. Actually, the time period's a little bit longer. The pattern we're looking at is this one, in that area. Now C, in this case minuet C, relative to A, is a failure. It failed to take out the low of wave A, and all the subdivisions within this structure are correct. Now eventually there was another zigzag to complete this minute wave 2, which did come under the A wave low. But it occurred, the pattern as a whole occurred in a very logical place, just prior to the onset of 3 of 3 of 3 of 3 of 3, right before a 700-point rally in the Dow. Now, only if you see a pattern that subdivides 335 would you then label it as a failure, and you would still expect to see that pattern subdivide into a 339 to complete the pattern. In other words, don't bet that this is the end of a correction. If you see that, this is a low probability outcome, essentially. Don't bet on this. Rather, what you would expect to see is that this 5 would turn into a 9-wave structure, taking out the low of the A wave. That's a much higher probability bet. I think that for the most part, any of us would only label a failure for a corrective pattern in retrospect. Would not label one in real time. That's how low a probability they are. So if you want to label this in this fashion and look for a move here, remember that's low probability. Rather expect to see 9 waves to complete the correction and move below that low. Let's take a look at page 237. With everything that's being thrown at us in the market all day long, makes things difficult enough, it's nice if you can be psychologically prepared for a move that's coming up. And if you bet on a low probability outcome, you're going to be caught off balance more often than not. Now maybe this pattern here can be counted as a failure. And don't let the fact that it says incorrect up here sway you. But maybe it can be, in which case what you would be looking for here would be a third of a third, or excuse me, a third of a fifth anyhow, but you'd be looking for 3, 4, 5, at least, to finish that structure. When instead, if you paid attention to the internal subdivisions and just the overall what's a higher probability bet here, this is best counted as a triangle, which says, okay, the next move up is the last one in this series, get ready to sell it, or be ready to sell it, maybe even move to the short side. As opposed to here, and remember, maybe you're only off by 1 or 2 degrees, but you're still looking for a 4-5 to complete this move. And that's going to throw you off balance. Let's take a look down here at the lower portion of the chart. Wave 2 here be counted as an irregular with a failure, in which case what you're looking at is the beginning of a third under this labeling. Now, a better count would tell you that your third of your third was already behind you, and that what you should be looking for when you get this correction that pulls back to the previous fourth wave of 1 lesser degree is a fifth to finish the structure. You cannot trade at your best if you're caught off balance or if you're psychologically unprepared. And that's why you shouldn't bet on low probability outcomes, and betting on a failure in a corrective pattern, especially without the correct subdivisions, is a low probability outcome. Now there's only one other concept relative to corrections. We need to understand it because it occurs frequently. Sometimes corrections, just like we discussed with impulse waves, can extend. We looked already at sharp corrections and how they, in essence, extended. A simple zigzag could be a double zigzag, or turn into a double zigzag, or a triple zigzag. And that's really an extension. But page 243 shows how sideways corrections can also extend. The figure at the top is a double 3. The middle figure is referred to as a triple 3. And the figure at the bottom is a pattern that we've seen turn up a number of times over the course of the last few years, to the point where we felt it was worthwhile to catalog it. And in this case, I would refer to this as a flat X triangle. And it's a corrective pattern where a triangle shows up with a flat correction in a combination. In this case, remember I mentioned earlier, triangles can never occur alone in a wave 2 position. But they can occur in combination in a wave 2 position, and we're getting ready to take a look at one of those. Now, as far as corrections extending, if a zigzag is the entire correction, typically the A wave will be more severe. If the C wave in a zigzag is more severe, expect the correction to combine. Maybe it'll turn into a double zigzag. Maybe a zigzag will combine with a flat. In a double 3 or a triple 3 correction, the final 3 in the series almost always ends in a dry up of momentum and a lessening of volume. This was true 1982. Correction ended in 1982. It was true in late 1984 and also in early 1985. Or some very classic cases of where you saw that type of dry up of momentum at the end of a corrective pattern. Let's take a look at page 244. The key, if you're still in a corrective pattern, and the correction is going to combine, completed waves in the direction of the previous trend will subdivide into 3-wave structures. That's the key, that the corrective series that you're in is not yet over. In other words, an X tells you, an X implies that there's more correction ahead. Let's take a look at what we just said. 3 waves up in the direction of the previous trend means the correction is not over. There's 3 waves up. Correction's not over. Here you can say the correction is acceptably completed. You finished a 5-3-5 zigzag at this point. But then the next rally subdivides into a 3-wave structure. The correction is not over. There's more correction coming. Same thing here after this B wave. Even though there may be other reasons that you would say, well, I know the correction's not over yet based on the wave structure, that is always a clue. Page 2.45 is just an example of that same concept. Each one of these rallies are 3-wave structures. And they all tell you that the correction that you're in, as painful as it may be, has not ended. Page 246 is a real-time example of a correction that combined. You've got a flat correction for wave A. Wave X turned into a triangle, which is considered to be a 3-wave structure, which means that the correction is not over, followed by a zigzag. So this would be a flat X zigzag if you're referring to the pattern. This took place in February through March of 1985. Let's move to page 247. That's one of my favorite charts. Here's that flat X triangle I was talking about. Now, the chart at the top of the page was first postulated by Bob Prechter in early September 1982. And what we see here is a 16-year corrective pattern, which began right here in 1966. You did an ABC down. Now, that could have been all of wave 4. You don't know at the time whether that's all of wave 4. You do know that you've acceptably completed a flat correction at this point, and then you begin to rally up. And you do, and at some point, that correction is best counted as a 3-wave structure. And what does that tell you? In spite of the fact that you've lived through a grueling 4-year bear market, the correction is not over. There's more coming. And there certainly was. The price damage was not all that severe, perhaps in terms of a current dollar chart of the Dow. But as Bob showed you earlier, it certainly was in other areas. And you traced out an ascending triangle, which ended cycle wave 4. Each of these patterns, this was an ABC correction here. And that 3-wave rally told you the correction was not over. There was more to come. Same thing with the B wave here, the X wave, this B wave, and the D wave. Each of those were 3 waves telling you the correction was not over. 3 waves in the direction of the previous trend tells you that there's more correction coming. Now, this pattern at the bottom is the stock market. This is July, August of 1984. Right here, this is early 1985. And this corrective pattern, ABCX, ABCDE, is also a flat X triangle. The triangle in the upper diagram is ascending. This triangle is descending. As I mentioned, a triangle cannot occur by itself in a wave 2 position, but as part of a combination, it can. What you had here, again, we've talked about how these patterns evolve over time. Time is not really a requirement. The pattern in the upper chart lasted 16 years. This pattern here lasted 5 months. We talked about all the corrective patterns. As a matter of fact, at this point, we've now covered all the patterns that were cataloged by Elliott. All the impulse patterns, all the corrective patterns. What we just learned, zigzags, Flats, and sometimes flats can be irregulars, as is shown here. Triangles, contracting, ascending, descending, and expanding. And sometimes, just like impulse waves do, corrections will extend and turn into a double three or a triple three, or some combination thereof, of the patterns. First and foremost, corrections can never be five-wave structures. If you count five-wave structure, it is never the end of the correction. It is only a portion of the corrective pattern. And remember that all corrections are followed by movements in the same direction as that which preceded the correction. And let me just put up the summary sheet, because this really has everything that you've learned about corrections. Zigzags subdivide 5, 3, 5. Flats subdivide 3, 3, 5. And triangles, every leg is a three-wave structure. Now, what can you say? What statements can you say about corrections given this? Well, A's can be 5s or 3s. B waves are always three-wave structures. There are no exceptions to that rule, to that definition. C waves are always five-wave structures unless they occur in a triangle. That's it for corrections. And let's come back in 10 minutes. I've got 2:25. How about 2:35? Thank you very much.